All right, let's dive into the latest earnings from Quantum Computing Inc., ticker QUBT. Now, on the surface, they reported a massive beat that got the market really excited. But as we're about to see, the headline numbers just don't tell the whole story.
So first up, what was the market's instant reaction? Well, the stock shot up 8.5% right after the release. You can tell traders loved what they saw at first glance, and the trading volume just exploded to almost 3 times the daily average. But the big question is, was all that excitement really justified?
And this is exactly why everyone got so excited. I mean, look at these numbers. QUBT posted a surprise profit of 1 cent per share that absolutely crushed Wall Street's expectation of a 6-cent loss. And then you look at the top line. Revenue came in at $384,000, which is nearly triple what analysts were predicting. Just a huge beat on both metrics.
But you know, whenever you see a pre-revenue tech company like this suddenly post a profit, you've got to raise an eyebrow. It always deserves a second look. So we're going to go under the hood and figure out what actually drove that positive earnings number.
And here is where the story takes a really interesting turn. That $2.4 million net income, it didn't come from their actual business. In fact, their core operations lost $10.4 million. The entire profit was basically manufactured by 2 things that have nothing to do with selling products: a non-cash gain on derivatives and the interest they earned from their huge pile of cash.
So let's be crystal clear about this. If you strip out all the accounting adjustments and the interest income, you're left with a business that is very much in investment mode. It's still losing a significant amount of money on its day-to-day operations.
And this slide, right here, this really illustrates the whole story for QUBT. On one hand, you have tiny, though growing, revenue. On the other hand, you have a pretty big operating loss. But both of those are set against this absolutely massive war chest of over $1.5 billion in cash. So this isn't a story about today's profits. It's all about what they plan to do with all that money.
So if they're burning cash on operations, what's the grand plan for that $1.5 billion? Well, on the earnings call, management laid out a very clear vision for how they're going to spend that capital, and it's all centered on scaling up their manufacturing and their photonics technology.
Their plan is really a multi-year roadmap. So, step 1, Fab 1 is now up and running, but it's for small batch production and R&D. The goal there is to perfect their process and start delivering for early customers. Then, from there, they'll start planning a much larger Fab 2, which is designed for high-volume production, to serve what they hope will be a huge demand from a bunch of different high-tech sectors.
And to prove this isn't all just theory, management pointed to some pretty big wins. The most significant one? They secured a quantum cybersecurity order from a top 5 U.S. bank. I mean, that is a massive validation point. They also talked about their work with NASA, their international partnerships, and growing interest from other customers as proof that their tech has real, tangible value.
But, despite these positive signs, the market is still deeply divided on this company. So let's take a look at the key questions and break down the arguments from both the bulls and the bears.
Okay, so the bull case is pretty straightforward. QUBT has a ton of cash, a cool technology platform, and some clear catalysts on the horizon. If they can turn these early projects with the bank and NASA into real recurring revenue, the stock could take off. The bear case, on the other hand, is all about execution risk. They see a story stock with no official guidance, a history of diluting shareholders, and a business that's still burning through $10 million a quarter.
This sentiment was actually captured perfectly in the media after the call. Barron's pointed directly to this bizarre situation. How can a company with less than $400,000 in sales report a multi-million-dollar profit, all while having this really high valuation? It just highlights the core skepticism that's out there.
And you can literally see that skepticism right here in Wall Street's outlook. Analyst price targets are just all over the map. You've got some saying it's worth $16 and others saying it's worth $40. A spread that wide tells you one thing. There is a profound lack of agreement and a ton of uncertainty about what this company is actually worth. So let's put it all together. You've got the headline beat but the underlying cash burn. You've got the massive war chest but this very divided view on Wall Street. What should investors be looking for next? Here's our take.
Which, of course, all boils down to the one central question for any investor looking at this. With this kind of risk profile, is the stock a buy right now?
For the next quarter, Q4, we expect revenue to keep growing, probably landing somewhere between $750,000 and $1 million. Now, unless they have another big accounting game, we expect earnings to go back to a loss, probably around 4 cents per share. But honestly, the number to watch isn't on the income statement. The single most important catalyst will be any news of follow-on orders from that top 5 bank. That would be the ultimate proof.
So our rating is outperform. Look, this is a high-risk, very speculative name, no doubt about it. But that $1.5 billion balance sheet gives them a huge runway and a pretty big margin of safety. That validation from a major U.S. bank is a real, tangible catalyst. We think the risk-reward here is skewed to the upside if management can execute on even a fraction of what they're promising.
This is not financial advice.